Welcome to the weekly update, where I'll go over the action in the market for the week of May 6th through May 10th, and then we'll see how things look for the week of May 13th through the 17th. We've had the third up week in a row now. Things are starting to improve. Of course, there's always things to be concerned about. In the upcoming week, we're going to have PPI, CPI, retail sales, and we're going to get a new read on inflation to see if the current scenario ends up actually changing. Where this is what kind of started everything a couple of months ago, especially with CPI. It came in stronger than expected. Then we saw another report that was stronger than expected. And so now, instead of the market really anticipating rate cuts, they were starting to worry about inflation. Well, then we had the employment situation report a week ago. That came in weaker than expected, and that really helped to alleviate some of the fears, and the market has been going back up. Now, we were pretty slow this week as far as actual movement. Most of the gains or even losses that we saw throughout the week came through the gap that was from the previous day's close to that day's open. And that happens with futures contracts that trade 24 hours a day. We are looking positive in the short, intermediate, and long term on the daily charts. We have some extreme positive readings, and we keep asking this question over and over. Does that mean we're overextended to the upside and due for a pullback? Or is that suggesting that there's good momentum behind the market? So we have to keep both of those scenarios in mind at the same time. So before I get started at looking at the different charts, I just want to go through a few things. I do post a video every day. And if you like these videos on a weekly basis, I break down things, and yeah, they're longer than a lot of other videos, but I kind of do that on purpose. I want to weed out the folks that are looking for quick videos and they're being told what to do, where I like to step back and do some analysis and commentary and help actually teach this so people can learn a skill for themselves. But if that is of interest to you, please feel free to check those out. And I post them every day. At least that's my intentions, is to post them every day, unless I am sick or traveling or just unable to do that. I am getting ready to launch a program in June. And I'm going to be locking down the daily videos starting in June, where they won't be available until after the close for that day. So if I have a video for Monday, a daily video, it won't be available until the market closes on Monday, because people that are in the program, they're going to have a chance to access those videos first. Now, I'm going to have another kind of situation where you will have early access without being necessarily involved in the whole program. But be thinking about that if you also watch the daily videos. And that'll probably be starting, I may kick it off right at the beginning of June. But there are some program videos on the YouTube channel, and there's also some videos on the Rumble channel where you can, I think I put 5 videos up there where I talk about the program and what I'm trying to do and the things that are involved in that program and the cost. It'll end up being $97 a month, and it's a membership. You can start at any time. You'll get a 30-day trial. You can stop at any time, and it goes way beyond what I do in these videos. Also, with every video that I post, there's a PDF that's in the description, and that's below the YouTube video as well as the Rumble video. Also, I'm now incorporating what has developed into a weekly video called a What to Watch video, and that's become quite popular, where I just focus in on the things that really seem to be speaking right now, and that can change all the time. What I'm looking at a couple of weeks ago is different than what I'm looking at right now. There's a few things that always stay the same, but this can change as market environments switch around. Every day I post pivot points on the YouTube community tab. I can't do this on Rumble. There isn't a community tab there, but this can be helpful. There's a daily chart, and those pivot points last for the whole month. I just update the chart each day with the new candle. There are intraday pivot points, which are very critical. A lot of the algorithmic program trading, they're based around this, and we can go right up or right down to a pivot point turn, and that's where we hit support or resistance. So that can be quite helpful to know. Also, I do have a private Facebook group. I may get to the point where I phase that out as I basically merge that with what I have planned for the program once it gets going. I just want a way that we are able to communicate back and forth. There will be a new poll that's posted this week, and I have the results to go over the most recent poll. And YouTube and Rumble comments, apparently there was another webinar again. I was running around having to play whack-a-mole as I get rid of all these crazy comments from these people that are self-professing Rumble and YouTube experts telling me how they can help me do so much better. I'm really pleased with the way things are going right now. Yeah, I may not be the biggest channel in the world, but the quality of people I have watching these videos, you cannot compare you folks to folks that also watch other channels that have a lot more subscribers. You guys are fantastic. I also post on Rumble and YouTube. Now, a couple of days ago, I think it was Thursday, Rumble's doing some kind of an update to their platform. And the interface looks different, and it took me forever to upload the video, and it took even many hours before I could even watch the video to test it out. If that ever happens, if I have a problem on YouTube or a problem on Rumble, that's why I post on two different channels, is because it's kind of a backup. So if you can't find me in one place, feel free to go over and look at me on the other platform. And here's the link to the Rumble channel, and I also have it in the description. All right, let's go back and talk about what happened this past week. So for the week, we were up 1.85%, not gangbuster, but it's the third week now that we've seen gains. We were below average with volume, and that is a bit of a concern for us to be going up, and volume's been getting lower and lower and lower as we've been going more up and up and up. And that's a warning sign. That's a basic rule of technical analysis. When you see a decline on low volume, okay, you don't take that as serious as if you see a decline on heavy volume. That shows more conviction. Same thing is true when we're going up. We should be seeing an increase in volume. We're within 1% of all-time highs on the S&P, and there should be a lot greater volume than what we're seeing right now. So that's a bit of a concern there. We are positive with our technicals. Some of the things are switching back and looking a little bit better. We're looking good on the daily charts for right now, maybe a little too good. There are always a few negative things on the daily charts and here on the weekly charts. And this week, it's going to be about inflation and interest rates. It's always about that every day. But we're going to get some reports that really feed into the whole inflation idea, which then can feed over into interest rates. And then the geopolitical concerns not really having a direct impact on the market right now, but that can always change. Something can blow up, and it can impact oil or gold or the dollar or stocks themselves. And that could be either positive or negative. But typically that's short-lived, but we still don't want to be caught unaware with those things. And then we did have some Fed speak come out this past week, but really nothing of note. Jerome Powell's going to be giving a speech, I believe, on Monday. And so folks will probably be tuning in to see what he's saying there. And they're all important, and they all pretend to be important to themselves, but it's really what the chairperson of the Fed actually says. All these other folks, they can say whatever they want, whether interest rates should go up 10% or we should outlaw interest rate. They can say whatever they want. It's what the chairperson says that really counts. Our trend, we're still on a weakening trend, but we are improving. The green line is on top, and it's starting to turn back up after it had been declining. So for the week, here's some bullet points. The major indices, that's the proper word. And if you're from the UK, that's probably how you say it. If you're good old American like me, we say indexes. So indices, indexes, tomato, however you want to say that. All of them, all the indexes that we follow had gains this week, and we saw good broad market participation. In fact, if there's one warning sign that we're seeing, it's that the Magnificent Seven and the NASDAQ 100 and the large caps that have really been driving the market higher, they're actually lagging right now. And that is a little bit of a concern. The S&P and the NASDAQ are less than 1% away from previous all-time highs. So we're getting pretty close there. Utilities and staples were strong, and I've been bringing this out on the daily videos. That's okay. Utilities and staples, they can go up, but taken together, especially if we're going and setting new all-time highs. This is what folks tend to get into when they're more defensive on the market. They think it's going to be sideways to down, so they get out of growth stocks, which go down a lot quicker, and they jump into utilities and staples, especially utilities because they pay high dividends. And staples, these are things that you have to have no matter what's going on in the economy. And so staples tends to hold up better when we're having really difficult economic times. And it's a little bit of a concern. Right now, we're just watching this, but to see these areas strong, it's a warning sign for right now. It could change at any time, but it was really noticeable this past week. And the post FOMC rally from a week ago, see, the Fed is starting doing a thing called they started doing quantitative tapering, okay, which means they're letting assets fall off their balance sheet. The bonds that they have, they're just letting them mature and then just go away into thin air. And so their balance sheet's been coming down. Well, it says they're going to stop doing that now. How do they stop doing that? They have to come in and buy. When they buy, that pushes bond prices up and interest rates down. And that's been helping interest rates, which have then been coming over into the stock market because the stock market likes lower interest rates right now and has been giving a boost to stocks. And then economic reports, we had a lot of economic reports this past week, but not like we had been seeing. It was kind of light in that area. And earnings reports, we hit the big number, but now it's the less influential companies that are reporting. We're not done with earnings season. It actually never really does finish, but it's starting to slow down a little bit going forward from here. And then interest rates, we were actually unchanged. We closed at 4.5% a week ago, and we closed at 4.5% this past Friday. So we were unchanged there, and the dollar index was up, but not very much. We're not seeing as much strength in the dollar right now as what we had been seeing. So here's a look at the main indices for the week, where the Dow was up 2.2%. It had been lagging behind. It actually performed about the best. And a lot of this was earnings related, earnings report, because the Dow's only 30 stocks. And so you get one or two earnings reports that come out, and the market really likes that. That can really help the Dow. And the inverse of that is also true. The NASDAQ was up 1.1%. The S&P was up 1.9%. And even small caps were up. The Russell 2000, they were up 1.2%. I've been watching this chart for a year now. It was just about a year that I brushed off this chart and started showing it in these weekly videos because it's a very long-term chart. And yeah, it's out of date, but we're still in this area. If you can see my pointer here, where we're possibly still going down with inflation. Now, we did blip back up at times, even when it was declining. That would be in about 1976 or so. And if you were to update this chart, we would just be a little further along than we'd be right about probably where my pointer is right now. The reason I'm showing this is that up until this point, what happened from 1966 up to 1982, we seem to be matching that kind of close. Another reason why I'm showing this is that, yeah, we still might see inflation go down, but I'm concerned about what potentially could happen after that. Now, we don't know if that's how things are actually going to play out, but if you were around from the mid to late 70s and you went through a thing called stagflation and super high inflation, no economic growth, little to no growth, and interest rates were going up, but wages were not being increased during that time, it was pretty ugly. And then it finally didn't get under control until we got into the early 80s. There's a lot of talk right now about stagflation. We had the economic or the employment situation report that was weaker than expected. Oh boy, stagflation, here we go. And people are getting all excited about that, thinking that they're declaring with absolute fact what is going to happen in the future when we don't know that yet. Okay, yeah, the employment situation was weaker than expected. But what about the next report? What about the reports that are going to come out this week? Now, if we start seeing more of a story unfolding and we're seeing the same kind of things as these economic reports are released, yeah, we go with that. But we don't know at this point if these were outlier type reports that just kind of blipped up before they're going back down, or blip down before they're going back up, or if we're starting to see more of a sustained trend for right now. That's why I look at all this information. I don't listen to those yahoos that declare this and declare that. Even if I'm wrong, I'd rather come to a conclusion myself because I feel more confident in that. And looking at the Renmac research, when we get above 4.02% with the 10-year yield, that's when it starts biting into corporate profits. We're still at 4.5% with the 10-year yield. Here's the poll from a week ago. The economic report calendar for the upcoming week is much lighter compared to the last few weeks. Do you feel that this will lead to more active price action or that movements will slow down and chop sideways? Most thought that it would chop sideways, 71%. We ended up actually going up on the week. Next one. Many indicators covered in the videos have already switched positive, but a few critical indicators remain negative. Have you turned positive or are you waiting for more confirmation? And it was split between needing more confirmation and I'm not really sure what's going on right now. And then interest rates in the dollar declined a week ago, and the interest rates were unchanged and the dollar was up this past week, which gave support to stocks. Do you feel that this will continue, reverse, or remain about the same? 63% thought that it was about the same. Well, you got that right with interest rates. Continue, 25%. You could say that a little bit about the dollar, but even the dollar wasn't, as I said, as strong as it has been. The S&P, as well as other indexes or indices, they're sitting right at their 50-day simple moving averages. That was a week ago. Do you feel that we'll go above, below, or remain at this level in the upcoming week? 57% thought we would stay at that level. We've gone above it for right now. So 14% thought that's what would happen. Here's some blog charts. Looking at the earnings, still, when we go out across the board, we're seeing this red arrow, which I put on here, by the way, but that is just showing, at least on a forecasting basis, that things are still looking positive when you look at earnings. And then looking at biggest outperformance of corporate bonds, maybe some of you aren't even aware that corporations do have bonds too. Most people think of government bonds, and there's a comparison between the two. And the corporate bonds, which are not doing all that great, but they're not doing terrible either, they are really outperforming government bonds more than, and I'm sure you remember 100 years ago when the last time we saw corporate bonds outperforming, but they've really been going up in relation to each other. And I deal with this in the intermarket analysis video. Financial conditions, when this is going up, that means they're tighter conditions, and that tends to strain the market. When this is going down, which is what it's been doing lately, that's looser financial conditions, which also can build into liquidity, and more folks are more apt to go in and buy some stocks. So that tends to be more positive. And then the April sell-off did not dent the market breadth. Now, this is looking at the whole world. This is world stocks that are above their 200-day moving average. And even though we had some downturn here, we really didn't see much of a hit when it comes to breadth, advance versus decline, both based on price and volume. So that's holding up fairly well. We did have FactSet come out with a couple of blog posts here. First increase in earnings per share estimates for S&P 500 companies for the second quarter, going back to the fourth quarter. I don't like this since the fourth quarter of 2021 because this doesn't take context into account. But looking over here on the right-hand side here, we are seeing that the estimates are going up or they had been negative. So that's looking more positive. This is showing price, what it's doing. And then this is the earnings per share from March 31st through April 30th. And this is hanging on for right now. Then their other one, and this always gets me too. If you take out Bristol Myers Squibb, the S&P would be reporting earnings above 8% for the first quarter. Well, if you took out all the stupid things I've done, I'd be a genius. Okay, you can't do that. You can't pick and choose. This isn't a buffet. I understand what they're trying to do with this chart, but you've got to include everything together. Now, there is a time to maybe exclude some things, but you can't lose sight of the big picture and what's really going on. Bristol Myers Squibb, they're still a real company. They still have an impact. They still hire people. They still have a big impact on what's going on globally. So just to take them out and then magically come up with better looking numbers, okay. That's where I come out on this. And it says the blended, when you take actual and then earnings that haven't come out yet, and they're still estimating those, year over year earnings, they're up 5.4%. If this is the actual rate, 5.4%, this will be the highest year-over-year growth since the second quarter of 2020. Okay, I don't like that sense stuff, but this just gives you a graphical representation of the earnings growth, and they take out Bristol Myers here. And this is also showing earnings growth. They take out some other companies to make this chart look a little bit different than it really is. Okay, let's get into our analysis. This is the daily chart, and for some reason it looks kind of strange to me, but we'll just kind of go with this. It's longer than usual, but right here is Monday, where we went up, and you can see a lot of the gains that we saw were really from the gap, even down, but we were able to recapture those. Didn't see much of a gap on Thursday, but we did see some strength going into the close. We gapped higher on Friday, came back down to the unchanged level, and then we're able to bounce up. So taking this from Monday to Friday, yeah, we were up on the week. Looking at the sectors, and again, I like to say this is only the 5 trading days. This isn't from Friday to Friday. This is just Monday through Friday. So the figures that you might read are going to be different than what you see here, where we have the Dow, where it's been lagging behind. It performed the best. The NYSE, a broad market measure, and then the S&P is in third place. And then we had the mid caps and the small caps. You know, they're a little further up in their range that they've been in. And this is a concern. We're seeing the NASDAQ 100 and the NASDAQ. Actually, the NASDAQ right now is outperforming the NASDAQ 100. This is a little bit of a concern, especially the NASDAQ 100. That has been leading the market higher when we're in a bull market. We need that to come back if we're going to turn more positive. If it doesn't come back, that has a potential of turning things more negative. Then looking back to the beginning of the year where we have the NASDAQ, and now the NASDAQ 100 is in third place. See, the S&P, it has the stocks from the NASDAQ 100 in it, but it has 500, actually 505 last I checked stocks in that index. And there's a lot of value in there. There's a lot of staples in there. There's utilities in there. And so this is helping the S&P actually hold up a bit better than the NASDAQ 100, which is pretty much all tech. And even the small caps ended up showing more of an improvement going back to the beginning of the year. Our different sectors. We had an up week. So look at this. Utilities are at the top. They were up the strongest. The financial sector, which has already been strong and could actually benefit the market. And then we have materials. And then here's staples down here. They were up too. Another defense area, real estate, which has just been getting hammered lately. It was up, not as much, it was more in the middle of the pack. But all of the sectors ended up being up for the whole week. Now, in this next chart, I rank these according to their scooter score. This is how is this sector compared to other sectors. And we have utilities in the 90s, followed by the financials. Those are looking the strongest right now. And then a bunch in the 80s, and we don't have anything negative, but discretionary. This is kind of like growth, but a lot of what's really dragging discretionary down right now is Tesla. And it's such a big company, and it is such an impact on this sector. That's why this has been really underperforming. And we'll look at our relative rotation graph. Look at this energy, and this goes over the last year, so it could be a little bit skewed with what's actually happening right now. Energy has been really looking better. We have materials doing better. And is this industrials right here? The financials are looking better, where we're seeing the tech showing some weakness. It's hard to see some of these letters. This is real estate, which is still pretty, no, this is real estate. This is healthcare. And this is something else where I can't see the letter. But some of these more defensive areas and areas that we get into when the economy is more in a mature state of advancing before we're getting set to not advance anymore, in fact, possibly go down. These are some of the areas that often can be stronger during the economic cycle. Then looking at the major indexes over the past year and comparing them with the Wilshire 5000, utilities, which have been way down here, man, they're just shooting up higher right now. The mid caps are still looking the strongest over the last year. The S&P has been strong. The S&P 100 has been doing okay. The NASDAQ 100 is now starting to show some weakness. The small caps have already been weak. They've been chopping around range-wise. The Dow Jones Composite and the transports. We really need the transports to show an improvement. That would really help the market improve. And looking at the sectors for the 5 trading days, where we had communication and utilities, industrials, energy, and financials were up, where the rest of the sectors were down, with real estate leading the way lower, followed by discretionary. Now, real estate, that's not necessarily a surprise. We have had interest rates going up and housing prices going up. So yeah, that hurts the real estate sector. We want to see discretionary doing better. And a lot of that's Tesla. Then going back to the beginning of the year, now utilities are doing the best on the year, followed by staples, 2 defensive areas. Real estate's up on the year, even though lately it's been getting hammered. We have materials and then financials, healthcare, industrials, and now communication, tech, discretionary. These are down on the year, going back to the beginning of 2024. And that's not right. This is not the beginning of the year. This is just for the week. I have these 2 charts reversed. I apologize for that. This chart is year to date. The next chart is just for the week, where utilities are up. Forgive me for that. Sentiment, we finally, we didn't move for a couple of days with the fear and greed index put out by CNN Money. We were camped down just at the high end of the fear range for a while. But here's looking at the chart, how it's been changing. So this tends to be more positive as we've been going back up with sentiment. When we get to an when we get to an extreme positive or negative reading, that's when we use it as a contrarian indicator. As long as it's moving in one way or the other, then we tend to go with that. The active asset managers starting to get a little extreme now. They saw things going up and they could be chasing some stocks higher also. And here's another reading where we had been more neutral. We bounced all the way up to 91.55 after being just a little below 60. Here's the VIX, which has been really going down, both here with the line chart and with the bar chart. And we're getting into an area where when we drop under 13 for the VIX, that's when the market sees its best returns. I know there's that old saying, when the VIX is low, it's time to go. Well, the VIX is low right now, but if you took that, the minute we get low with the VIX, then of course, what is low? There's the static number low, and then there's the relative low. But if you went, you would miss out on a lot of gains. But we're just seeing that there's not a lot of fear in the market. The Ulcer Index has been going a little bit sideways here. It's actually dropping down on the daily chart. And this chart, and then the one right after this is the spread between risky and not as risky bonds. This is going down, and we're getting very low readings here. So the bond market's not seeing an awful lot of risk right now. This is that same chart. We have the S&P up here on top. This is showing that ratio that I just showed you, how it's been going down a lot. And that could end up being more positive for stocks. When this is really going up, that's more negative for stocks. The latest reading from Investors Intelligence, we're coming back up. We're still pretty much neutral. We're coming in at 2.67. When we get above 3, that's when we're starting to look extreme. The latest reading from the American Association of Individual Investors, they're going up, and the moving average is going up, but they're not extreme right now. And then looking at the AAII bull bear spread, where it is bouncing up. It's the same chart is what I'm showing you here. This is just showing you this same reading a little bit different way. Sometimes if you look at the same information a little bit differently, it might give you some insight that you didn't have before. And looking at cash and comparing it with the tech sector, we're still going down again with the black line. So that's positive for the tech sector. And then looking at some economic measures here, we have the latest reading of GDP now, a little bit under 4%. When we look at the top economists, they're coming in just under 3% to the upside and at about 1.5% to the downside. The takeaway from this, now that we're moving further into the quarter, is that we're seeing this band starting to slowly go up. And so that's showing more improvement economically, at least on a forecasting basis. This also shows you now we're starting to pretend we know what's going to happen in the second quarter of 2024. We've had all the readings now, other than revised earnings or revised readings, which may come out in the future for the first quarter. Now we're focusing on the second quarter. And the Ridex bear bull ratio, these poor folks have just been getting whipsawed. A week ago, not so much this past week, they had become extremely bearish. They were getting into the bearish funds, and then we started going up, and then boom, now they're back to being bullish again. Then the latest reading of the national financial conditions, we're flattening out here, but we're still below the black line. So that means we're okay there. And then this was updated last week with the real-time solemn recession rule indicator. We are going up, but we're still below the red line. We go above the red line, that's when we get concerned. And then the smooth US recession probabilities above the black line, but we're not above the red line. That's when we get nervous. And the latest reading from the Brave Butters Kelly leading index, it came down right at the end of April when this was updated. Inflation, and this is going to get adjusted in the upcoming week as well with CPI and PPI coming out. Fed Watch, okay, as of right now, there's a 96.5% chance that when the Fed meets on June 12th, they will leave rates unchanged. And we're not seeing an awful lot of change in that consensus right now. In fact, it's getting a little bit more of a conviction. The dark blue is where we're at right now, day ago, week ago, month ago. And this is getting more locked in at the present time. Now we look out at the July 31st meeting. So, and this is starting to go up too, the 74.6% chance that they're also going to keep rates unchanged at the July 31st meeting. And that is getting more of a conviction over time, where it had been a lot of other people were thinking other things would happen, but the Fed's gone back to this higher for longer approach to things and kind of leaving us, well, are there going to be any rate cuts at all? Well, at least they're not going to raise rates unless we start seeing some really strong economic reports consistently. And then we look at the assets for the balance sheet of the Fed, which is continuing to drop off. But you see over here, this is a plus. It actually went up a little bit, even though you can't see it right here. That could be the Fed coming in and actually doing some buying. And the market tends to like that, even though this was unthinkable 15, 20 years ago. And the Fed said, we'll never do this. Now it's pretty much an expected thing. All right, and then we look at the balance sheet here on a year-over-year basis, where it is continuing to fall off, but not with the same amount of falling off that we had been seeing before. Now, looking at breadth, we're looking okay here on the weekly chart based on price and volume. And we're looking good on the daily charts as well. Also, I've been really focusing on the daily charts with the new highs, new lows. See how we're really starting to expand the new highs? So we're going up with the 4-week and the 10-week moving average. This is a good, solid internal measure, and it's showing strength internally in the S&P for right now. The advanced decline ratio is above 0 and going up. Accumulation distribution, this is a smart money indicator, also based on volume. This is above the moving average and going up, and we're also seeing an improvement with the daily chart, where it's not as far above the moving average, but it is above the moving average right now. Looking at our trend, we're starting to turn back up with the green line, but we're still in a weakening trend because the ADX is below its moving average. But as long as that green line keeps going back up, we can default to the positive on the weekly charts. The Erin is still positive, even though it came down just slightly. It measures the green line on top, which are buyers, and that's decreasing. The sellers, which are pegged at the bottom, they really haven't changed. So that's why we're seeing this oscillator coming down. But since the green line's on top, we are positive. We're getting a signal on the mass index for the daily chart. And once it crosses above the red dash line and then the blue line and then comes back down below the red dash line, it thinks that the market is going to reverse from whatever it was doing to make that trigger happen. We've been going up, so that potentially could suggest a reversal, but we're not really seeing any confirmation of that in our other charts. We're not seeing any signal here on the weekly chart of the mass index. Daily chart here, we were able to get above this pivot point. So we broke through that, which had been acting as overhead resistance. We're above the 50-day moving average. The long-term trend is still up, but you can see, and this is a daily chart, where volume has just been going down, 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 as the S&P has been going up, 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 and that's a warning sign. When we look at the Keller market model in the short, intermediate, and long-term, we're positive with all of the indexes. When we look at some other markets, we're positive with stocks across the board. We're positive in the short term with bonds based on price. We're negative with commodities in the short term based on price. And the dollar in the short term is now in a downtrend. And there was a bit of an update here. We're looking better with the PMO on the daily chart, but it hasn't switched over to positive here yet, where the trend is positive across the board. But in the short and long term, we're still negative with the PMO, where the intermediate term continues to be positive. We're looking okay here with our trend channel. We're well above the midpoint and now going back up. And this chart, we're up above this R1 level now. We closed above it on Friday a week ago. So now this is the second week we've been above this R1 level. So that is also quite positive for the time being. We're going back up with the 50-period simple moving average. Price is above the moving average, and the moving average is going up. The long-term trend, the blue line's above the red line, and we're above both lines now. That's positive. The McClellan oscillator is getting above this extreme positive reading, but it still could go up from here. So this is positive, but possibly a little extreme positive. We're going back up with the summation index based on price, and we crossed back above zero based on volume. So this is turning more positive. Swenlin trading oscillator, which we're watching this, it's giving us a little bit of a warning sign after Friday's session, but we're going up here based on price and volume. So it's positive longer term. The bullish percent index also has been going up on the daily chart, and it's going up here. They're confirming each other, and that's positive. We're going up with the PMO based on price and volume, but it's going to take a while to turn back up and go back above its moving average. Where on the daily chart, all of our oscillators are now positive. When we look at the PMOs that are rising, that's going up. The buy signals are going up, and the PMOs that are above zero is also going up. So we're seeing some internal improvement with the PMO on the weekly chart. The percent B, we're above the midpoint and going up. That's positive. All of our oscillators continue to be going down, where we just finally, as of Friday, clicked over to positive on the daily charts across the board with these same oscillators. Chaikin money flow just barely turning positive on the daily chart, where it's flattening out a bit here, but still positive on the weekly chart. We're going back up with the Chaikin oscillator. The force index is above zero and going up. We're positive on the daily chart and here on the weekly chart. We're still positive with the money flow. It's above 50, even though it's flattening out. The rate of change is going up since we had an up week. 50 weeks, we're above this red line, which sometimes signals some kind of a top. But if we get good momentum behind us, we can go a lot higher than this red line. The RSI 14, which had been declining, is now turning and starting to go back up. The weekly special K chart is still below the moving average, and it's been below ever since July of 2023. It just cannot go positive, where the daily chart is still positive. Stochh RSI starting to go up, not quite to the midpoint yet. And the Williams percent R, we're starting to get extreme positive here, and I actually have a different version. This is the same chart, just looking at it in a different way. This is a weekly chart of the S&P on top with all these little projections right here. And this is also showing this is really, and it ends up being positive for the market. It says, looks like a bull market dip. So we came down and then we're going right back up as of right now. The ultimate oscillator came right down to 50 and now is bouncing up from 50. The vortex is turning back up, and that's positive. The Copic curve is still negative. We're positive on the daily chart, but we're negative here on the weekly chart. We were able to break above this 10-week moving average. That is good when we can recapture support. We're declining with our 253-period equity put call ratio. That, when it's going down, that's positive. We're starting to turn down when we look at the VIX and then take a 3-month average of the VIX. That is turning more positive. And with our different charts, we're looking positive again with the Heiken Ashi. We're looking positive with the Kegi, positive with the Renko. And we're still looking negative here with the 3-line break. It's not convinced yet. And we're looking positive with the ease of movement. We came almost down to zero, but now we're starting to turn back up. And we had some new X's drawn in for the point and figure chart. No signal was generated, and we're seeing the same thing on the daily chart. Now, I do have a daily version of this and a weekly version of this, and so usually there's a slight variation between the two. But for right now, they're kind of showing us the same thing. When we look at momentum in the long term, we are still declining. We're turning back up in the intermediate term, and we're turning back and looking more positive in the short term. And we're kind of getting into, I'm not sure when this 50-day cycle will end. The last one was on March 21st, so we might be getting kind of close to that. But I just use this as something interesting to follow. I don't use this to make any decisions. We are turning back positive with the Elder's Impulse system for the S&P, and this is big. We are positive on the daily chart with the parabolic SCR. We now have a dot underneath on the weekly chart. That could be quite positive. That's a confirmation now. The month of May, if you just go back to 2020, this tends to be a pretty good month. Sell in May and go away. I have some other charts to show you later on that over the last 10 years, that would not have been a good thing to do. Looking at just the indexes without any studies on them, we're getting really close to the all-time high with the S&P, not too far away from the mid caps. Still have a ways to go and to get back there with the small caps. The Dow is in an uptrend and above both moving averages. The NASDAQ is above moving averages and in an uptrend. That same thing with the NASDAQ 100, even though it's been underperforming. Let's see. No, on a percentage basis, the NASDAQ 100 actually did better. And we're looking better here with the QQQs. The mid caps are also above both moving averages and in an uptrend. Small caps, yeah, they were up, but see how we've been range bound? Pretty much going back to 2022 here on the weekly chart. But this has been a really frustrating area. Now, if the interest rates can go down, the economy can still look pretty good. That would really help small caps to advance. But there's all these teasers that keep coming into the market, and the stock and the small caps think, okay, here we go. Nope, gonna change the scenario. Let's go sideways to down. And then another scenario, Goldilocks is here, go up and then down. And it's just made it very choppy. The NYSE is above both moving averages and in an uptrend. The Wilshire, another broad market measure, above. Now, this is a daily chart. We're above the 50-day moving average and in an uptrend. All stocks also in an uptrend. And software companies bouncing off their 50-week moving average. So they're showing some improvement, but not an awful lot of strength in here right now. But they're still in a longer-term uptrend. The FANG index is breaking out above its 13-week moving average, so that's been showing an improvement there. ARC, nah, not so much. It was actually down over 5.5% on the week, but it's still in an uptrend. But if we keep going down, this is going to cross over and look negative. The banks are still looking pretty good. When we look at these weekly bars here, we're going up with the RSI. Momentum is trying to turn back and look more positive. The deposits are coming back into the bank, showing that there's confidence there. And looking at just a plain weekly chart of Dow theory, where we're starting to go up with the Dow, we're really lagging behind with the transports. The perma bears love to point out that this is a non-confirmation of Dow theory, and they're right. Is it going to stay this way is the problem. And then you can see here, utilities are just going crazy right now to the upside. Broad market, the CRB index has been pulling back, coming back down to its 13-week moving average, but it's still in an uptrend on the weekly chart where it's turning negative on the daily charts. Oil also is coming back down. Things seem a little bit okay in the Middle East for right now, at least enough to keep oil from going really high. Copper, this is an economic measure here where it's really been going up. It was up 2.32% on the week and is still in an uptrend. And the dollar was up slightly. It's still in an uptrend on the weekly chart. It's having a little bit more trouble on the daily chart. Gold, after falling back, it was up 2.7% and in an uptrend. Silver was up 6.4% and in an uptrend this past week. Looking at bonds, where we're looking a little better with bonds based on price. We bounced off of the 50-week moving average. So that's showing an improvement. Stocks continue to outperform bonds on the monthly chart. And we're still negative with the 1 month and subtracting the 3-month yield as it should be. Here's a daily chart of the yields where we had been going up. Now we're starting to come back down, even though we were up in Friday's session. And then the weekly chart looking at US and UK rates, which declined on the week, and then German rates and Japanese rates ticked down just a little bit. Some relative studies, we now have oil falling enough where gold is now overtaking oil as the best performing asset going back to the beginning of 2024. And then we have stocks, and then the dollar and bonds based on price are still negative on the year. The ratio between the NASDAQ 100 and the S&P, we want to see this going up. This has been going down as the NASDAQ is actually, the NASDAQ 100 has been underperforming the S&P 500. But the S&P 100, even though it ticked down a little bit, is still really outperforming the rest of the S&P 500. Growth to value, we want to see this going up. It's doing okay, but we want to see some more strength here. And gold to the S&P, it's still in a downtrend. Now it's really improving, but it hasn't crossed over positive yet in the long term with this ratio. And gold to the dollar, it is breaking out above these trend lines and has been holding up compared to the dollar. Bonds continue to underperform. Stocks on the weekly chart, low volatility stocks are still underperforming on a long-term ratio basis when compared to the S&P. Discretionary, we want to see this going up, but it's going down and in danger of seeing a long-term death cross here when we compare discretionary to staples. Energy, which had been doing quite well, is now falling back a bit as tech is seen. Well, it didn't really change all that much here, but in the longer term, energy is still in a downtrend when compared to tech. Then our longer term breadth thrust here with the NYSE, this was triggered in October 2022, and that still is on the books from what I know. We did not get an official ZWAG NYSE breadth thrust. We went up here, but it was a day too late. We didn't get there within the 10 trading days. And Jason Gepfert, who runs a site called sentimenttrader.com, which is a fantastic website. I wish I could show you his charts, but I've actually talked to him and he said, nope, can't do that. Copyright. So I don't, but I can tell you what he said. He said, maybe we got close enough with this thing, even though we missed it by a day or two here. Maybe that's still positive for the market. Just something to think about. The Horchak is still on a full-on buy signal. We're still above the trend line going back to the 1987 crash with the weekly chart of the S&P. This is a further blow up of that same chart, and we're looking better there. We're starting to turn back up with the NYSE new highs minus the new lows. Now, I know this is, okay, new highs, new lows, and then a 50-period moving average of a 50-period moving average. That's like voodoo. That's like taboo when it comes to technical analysis. That's why I do it. A moving average of a moving average, you're not supposed to do that. But we're looking a little better here. And then the 50-period new highs, new lows just for the S&P. This is also starting to turn back up. If it keeps going up, that would be more positive. We're getting back above this weekly trend line here with the NASDAQ 100 going back to 2009. And we're coming back up to this all-time high here with this long-term ratio between the NASDAQ 100 and the Dow. This is what the perma bears are waiting. They're waiting for this to fall apart. And they've declared it for 6 or 8 months now, and it's just not happening yet. And that's why I say this in the daily videos, I'm not a perma bull, I'm not a perma bear, I'm a perma realist. The thing that bothers me about these folks is that they still stay bearish in the face of all these positive things happening. Nope, there's still a crash around the corner. Everything's going to fall apart. Anyway, they stick to that no matter what evidence you have to say maybe you could take a little different stance for right now. And then looking at the Qs to the small caps, we're just a little bit below this blue line here, but still at a quite high reading. And then we're still going down here with the new highs minus the new lows cumulative for the NASDAQ, where we're coming back above zero on the daily chart here. And if we stay above zero for a while, that's going to turn the cumulative back up as well. And we want to keep an eye on the 3-month yield. We're just going sideways right now. If it really starts going down, then we'll start to freak out about something. Seasonality. This is Don Bird's chart where May, typically going back to 1950, has been a period of weakness. And then looking at this I've been showing this for a while, where we're still kind of mirroring what happened back in 1982. In fact, we've been actually outperforming that. But once we finally got through that mess in the early 80s, stocks really took off. And that appears to be what has been happening here. May has a positive track record, but pretty anemic returns when you go back to the election years to 1950. In May, looking here, going back to 1950, April was the strong month, according to this, or one of the stronger months. But May also can be a strong month. And then on a world basis, April is the strongest month of the year, where May's up, but not all that much. And then I've taken these from the daily video and put them over into the weekly video now. This is the gradual trend lower that we often see in May. And May, the first part, which we're kind of working our way through right now, tends to be negative. But when you look at this, during an election year from 1950 to right now, Carson's coming up with a different answer. They have us up 77.8% of the time with a return of 2.3%. Okay. And then, but this one shows that from May to October is the worst 6 months, according to Carson. And then over the last 10 years, they came out and said, with Carson, I mean, that's they. But the last 10 years, we've kind of taken that sell in May and go away and kind of done a lot better than that, where we've been up 90% of the time with a median return of 1.1% in May. Then we want to look out a little further. June, July, and August tend to be good during election years. And this is another chart that came from the daily video. According to the Stock Traders Almanac, we see weakness going into May. This is another Carson chart also showing some weakness before we see some strength into the summer months. And this is kind of weird. The 1968, yeah, for a while they thought because of all the crazy stuff going on in the country right now, well, we're not following, that's the green line. We're not following that at all, but we're kind of following what happened in 2012. And if we do end up continuing to follow that throughout May, we will possibly see some more weakness on a seasonal basis. You can always buck the trend here, but historically, this is what happened from 1949 to 2023. This is another look a little further out. June, July, and August tend to be during a fourth year of a presidential cycle. This is when the stock market sees pretty good gains. Thank you. I really hope you found this helpful. Please feel free to check out the other videos that I post. I hope you have a wonderful weekend, and I will talk to you in the next video.